Okay, let's unpack this. We're doing a deep dive into an investigation that really shows how numbers in corporate finance can lead a complete double life.
Right.
We've gathered sources from thousands of pages of, confidential documents. We're talking tax returns, IRS audit data, bank reports, internal financials, all focused on the business mechanisms used by Donald Trump's organizations.
And our mission today is pretty straightforward. We need to understand this sort of structural mechanics that allow for two totally different financial realities for the exact same asset.
And the journalists who did this work, they used a metaphor that I think is just perfect for this, the Matryoshka doll.
It really is the best way to picture it.
I love that analogy. It's so simple, but it perfectly captures the complexity we're about to get into. So tell us about that doll.
So when you look at the outside, you see layer one, the beautiful, glittering asset,
Mhm.
a 90-story skyscraper, a five-star hotel. It just projects success.
But then you open it up.
You open it up,
Yeah.
and you find these inner layers that tell a completely contradictory story.
So what are these inner layers hiding?
Well, the first inner layer is the reality that's tailored for the IRS. It's all about maximized paper losses, uh, aggressive deductions, depressed valuations,
Mm-hmm.
anything to minimize or just eliminate tax.
Okay.
Then the next layer is the reality for creditors, for the banks. Massively inflated valuations, really optimistic income projections, and, minimal expenses. All of that is designed to get the best possible loan terms.
So this deep dive is less about politics and more like a mechanical instruction manual. We're trying to figure out step by step how the same building can be worth $1 billion when you're asking for a loan
Mm-hmm.
and basically worthless when you're filing a tax return.
And that systematic tailoring of the numbers to the audience, that is the absolute heart of this investigation. The figures aren't just, slightly different. They're fundamentally contradictory. And we need to trace that to understand why, in this kind of environment, a loss actually becomes an asset.
Let's start with maybe the most aggressive example the investigation found. The Chicago International Hotel and Tower. Huge 92-story project.
Hugely ambitious.
And it launched right before the 2008 financial crisis hit. And the sources say it just immediately started racking up these colossal losses.
It was a serious problem, for sure. And look, recording losses on a project with that much debt is normal. But the investigation really zeroed in on this radical step that was taken in 2008.
Okay.
To manage those losses, the ownership stake in the project, the equity, was declared worthless, just completely devalued.
Wait, I have to pause there because that sounds completely absurd to the average person. We're talking about a standing, functional 92-story skyscraper. How can a physical thing like that be declared worthless on paper?
That's the essential distinction, right? Between the physical world and the accounting world. The sources are clear. This isn't about the building vanishing. It's about the value of the owner's equity stake.
Okay.
The legal argument was that the project's debt had just ballooned so far past any realistic market value that the owner's interest in it was, theoretically zero
Yeah.
or even negative.
So the asset was completely underwater relative to the debt.
Precisely. And making that aggressive assessment allowed for a massive single write-off of $651 million.
In one go.
In 2008, it was a spectacular accounting move.
$651 million written off in 1 year. Can you just ground that number for us? What does a write-off of that size actually do for a business?
It creates this huge, durable tax shield.
Right.
Imagine that $651 million as a negative balance in a special tax account.
Right.
Any future profit from any other part of the business can be offset tax-free
Right.
by just drawing down that negative balance.
Mhm.
And because the loss was so huge, it could be carried forward for years and years, shielding future profits from federal tax almost indefinitely.
So you're basically weaponizing the failure of one project to protect the success of all your others.
That's a great way to put it. And the sources point out something crucial. At the time, the IRS did not challenge this specific $651 million deduction,
Yeah.
even though the scale of it was highly unusual.
Okay, so that's Act 1. The giant write-off creates the tax shield, but the story of the Chicago Tower didn't end there.
Not at all.
We moved to 2010, and the sources suggest another maneuver that some critics called double dipping on losses from the very same project.
This is where it gets even more complex. So in 2010, the company that held the Chicago asset did an internal legal transfer.
Okay.
The property was moved from the original company into a new, specially created partnership. But the investigation stresses that actual control over the building, that never changed.
So nothing really changed except the legal wrapper around the asset. Why do that? What was the financial reason for this restructuring?
Well, the sources allege that this technical move was then used as the justification to claim another loss on the very same Chicago project.
You're kidding.
An additional $168 million loss was declared, and this was then spread out over the next few years. Sources called it moving coins from one pocket to another because you're generating a fresh loss without any real change in the business.
So if I'm getting this staggering logic right, first, you declare the asset completely worthless in 2008, taking a $651 million deduction.
Right.
Then 2 years later, you change the letterhead on the legal documents and claim it has somehow lost more value, another $168 million, even though you already said it was worth zero.
That sequence,
Yeah.
that is the absolute core of the dispute that eventually triggered the IRS audit. Writing an asset down to zero and then continuing to claim more losses on it.
And what was the IRS's argument against it?
It was simple, but, powerful. You cannot keep claiming losses on something you've already fully written down. It doesn't matter how many times you change its legal name.
And the money involved here is just huge. What's the potential liability if the IRS actually wins on this specific point?
ProPublica's reporting estimates that if the courts side with the IRS on just this Chicago case, the total financial hit that's back taxes, penalties, interest could easily top $100 million.
Wow.
Yeah. It just shows the enormous stakes riding on how you define a new loss versus a recycled one.
So the story of these paper losses shows us the pessimistic side of the Matryoshka doll, the one aimed at the federal income tax system. Let's flip to the optimistic side now, the strategy used when the goal isn't to reduce taxes, but to get financing and lower property taxes. This is where we get to the two sets of books.
Yeah, that phrase sounds like something from a movie, but it accurately describes what was happening with some Manhattan properties, especially 40 Wall Street and the New York Trump International Hotel.
And the journalist compared two different sets of documents for the exact same time periods.
Exactly. Set one was the glossy presentation that went to major creditors like Deutsche Bank when they were looking for loans. Set two was the much more somber version sent to New York City tax authorities.
And this is critical. In New York City, your property tax isn't a fixed thing. It's tied directly to the assessed value of your property, which is heavily influenced by the actual income it generates.
Exactly right. So when the journalists put these numbers side by side, the income, occupancy rates, expenses for the same time frames, they found these massive systematic differences.
The kind that can't just be explained away by standard accounting rules?
Not even close.
How big was the difference? Give us the most dramatic example they found.
In one case, the reported rental income for a New York property, the figure they gave to the bank was almost twice as high as the figure they reported to the city tax authority
Twice as high.
for the same period.
If you're the bank and you see that document, what does it tell you about the asset versus what the city auditors are hearing?
It's a completely intentional signal. For the bank, the goal is to paint this picture of amazing success. Occupancy is high, income is strong, expenses are low. It makes the property look like rock-solid collateral.
Justifying the biggest loan and the best interest rate.
Right. But for the tax authorities, it's all reversed. Income is modest, expenses are high. This sort of depressed financial picture gives you the argument you need to challenge the city's valuation and demand a lower property tax bill.
It's an effective strategy. Promise prosperity when you need cash, plead poverty when the tax bill arrives.
It's effective, but it pushes right up against the edge of legality.
Now, when this stuff comes to light, the defense is usually that this is just aggressive but legal practice, or that, you're using different standards like GAAP versus tax accounting. What did the experts say to that?
They all agreed that yes, minor differences are normal. GAAP and tax rules treat things differently. But they argued the scale and the systematic nature of these differences were just too big and too consistently one-sided to be explained by that.
So it wasn't an accident.
They concluded the figures appeared to be deliberately tailored to get a specific result for a specific audience.
And that deliberate tailoring, that's what moves it from the gray area of optimization into the red zone of potential fraud, especially because you have to sign tax filings under penalty of perjury.
That is the critical difference. It all comes down to intent. And it's really important to note that this exact logic systematic overvaluation to get financial benefits, that was the foundation of the recent New York civil case.
Right.
And the court in that case found liability, which led to those massive fines. It concluded the figures given to the banks were in fact misleading.
So we've seen the modern techniques, But the investigation also shows this isn't some new invention. It seems to be a systemic, multi-generational business strategy that goes all the way back to Fred Trump.
The sources draw a very clear historical line, connecting these strategies today to the techniques uncovered by that Pulitzer Prize-winning New York Times investigation.
And what was the core financial game being played by the previous generation?
Their main goal was all about avoiding inheritance and gift taxes, and they did it by dramatically undervaluing assets. We're talking by hundreds of billions of dollars when they were transferred between generations.
So the principle was established a long time ago.
A long time ago, the core idea that an asset's value is not fixed, but a flexible number you adjust based on your goal, that's been there for decades.
The strategy just evolved from a simpler undervaluation to this complex, layered matryoshka game that really relies on exploiting the tax code itself.
Exactly. And that brings us to the bigger picture, which is maybe the most important takeaway from all this. This whole story is really a diagnosis of the systemic environment that the ultra-wealthy operate in.
Right. It's not just about the numbers. It's about enforcement and resources.
On one side, you have enormous wealth that employs an army of high-priced lawyers and tax strategists whose entire job is to exploit every loophole in the code.
And on the other side?
On the other side, you have the IRS, the main enforcer, which is chronically underfunded, outstaffed, and just struggling to fight these huge corporate resources on, anything close to equal footing.
So they're basically relying on the sheer volume and complexity of the paperwork to shield them from a real audit.
That's the diagnosis. The cost and the difficulty of auditing a system this complex, especially when the information the feds get contradicts what the banks get, which contradicts what the state gets, it creates an enforcement nightmare. The complexity itself is the ultimate shield. And in that environment, a huge loss isn't a setback anymore.
Right.
It becomes an incredibly valuable asset, one that guarantees tax freedom for years.
It's the cost of entry to the game. If you can afford the resources to navigate the complexity, you can change your own tax reality.
That's the core conclusion.
Okay, let's wrap up this deep dive by just summarizing the 3 key layers of the Matryoshka doll that this investigation really opened up.
I'd say there are 3 main mechanisms. First, the really aggressive, creative use of paper losses, like the attempt to double dip on the Chicago Tower, turning a business failure into a tax shield.
Okay, 1.
Second, the systematic creation of these dual financial realities. The optimistic story for the banks to get credit and the pessimistic one for the tax authorities.
And the 3rd?
And third, the evidence that this isn't just a one-off thing. It's a multi-generational evolving business strategy that relies on exploiting these legal gray areas.
And for you, the listener, we should just reiterate the current legal status. The overvaluation strategy was confirmed by the New York Civil Court ruling, but the claims about the double loss on the Chicago Tower.
That is still subject to ongoing IRS audit and court disputes.
Right.
And of course, the consistent response from the organizations has been a blanket denial of everything, framing it all as politically motivated.
But if you step away from the specific names, this investigation really exposes a fundamental problem in our financial system that affects everyone.
It does. It forces you to confront the fact that our incredibly convoluted tax code allows for financial engineering on a scale that creates literally contradictory realities for the same money. And it all leads to one unavoidable question. Go on. Given the resources involved and the intentional blurring of the lines, where exactly do we draw the line between lawful tax optimization, which everyone is entitled to, and outright fraud?
And maybe the most critical thought for you to carry forward is this. Are we in a system where that line is just too complex, too expensive for our own enforcement agencies to find and defend? A system that effectively allows the ultra-wealthy to play by a completely different set of financial rules than a small business owner or an average person. That complexity is the shield, and that's the ultimate point for you to keep pondering.